All right, so I welcome you to today's conversation. Just as I told you last time, we need to continue preparing, for this assignment that is just ahead of us. But you see, after going through the assignment, I've realized it's important for you to understand some key standards that you will be using in the assignment. Just as I told you last time that every adjustment actually within those the statement under published accounts, you find that it's a standard on its own. And actually there is a standard that encompasses taxes, and there is a part where you talk about or you present taxes in the published accounts. So it's very important. Actually, there are not many of the workings that are complicated within a published accounts because most of the workings were done under consolidated statements. Okay, but the key workings that you really need to understand are issues around the IS number 12, which is about income taxes, or how do you handle taxes. And then there is also IS 23, borrowing costs. You need to understand that. You also need to understand the contracts, okay, IFRS 4. When you understand those key things, they will really help you to tackle that assignment successfully. Before I comment on the assignment, it's very important that we go through IS number 12. And so we have an examination question that we have before us. I have not adjusted anything. This is the question that I need to read. And once we will use this question to explain IS 12, International Accounting Standard number 12. And so listen carefully as I read the question, and then we'll answer this question. As we'll be answering this question, I'll be explaining some of the key concepts that guide IS number 12, International Accounting Standard number 12. Okay, the question was number 2, and it's read, the objective of International Accounting Standard number 12, income taxes, is to prescribe the accounting treatment, okay, for income taxes, right? For the purpose of this standard, income taxes include all domestic and foreign taxes, which are based on taxable profits, right? Income taxes include all domestic and foreign taxes, which are based on taxable profits. Now, income taxes also include the taxes such as withholding taxes, which are usually payable by a subsidiary, associate, joint venture, on distributions to the reporting entity. It is said that the principal issue in accounting for income taxes is how to account for the current and the future tax consequences of, number A, the future recovery or settlement of the carrying amount of assets, okay, or liabilities that are recognized in the entity statement of financial position. That is the area of interest. To understand how to account for the current and future tax consequences of A, the future recovery, or settlement of the carrying amount of the assets or the liabilities that are recognized in the statements of financial position for the entity. B, the transactions and other events of the current period that are recognized in the entity's financial statement. So the transactions and other events of the current period that are recognized in the entity's financial statement. Now listen carefully. The question will start here. Zamtax PLC purchased an item of heavy industrial machinery for $180,000 on October 1, 2015. It had an estimate useful life of 10 years and a residual value of $10,000. Now, plant and machinery is depreciated on a straight line basis. Now, the tax authorities do not allow depreciation as a deductible expense. Instead, tax relief is granted based on an allowable deduction of 30,000 of the cost of the asset in the year in which the asset is acquired, followed thereafter by an annual allowable deduction of 15% calculated on a reducing balance basis. Didn't hear this part. I am saying the tax authorities do not allow depreciation as a deductible expense. Instead, tax relief is granted based on an allowable deduction of 30% of the cost of the asset in the year in which the asset is acquired, followed thereafter by an annual allowable deduction of 15% that is calculated on a reducing balance basis. So the applicable tax rate is actually 20%. What is required? What are we required of doing? That is what is necessary. The required is that we explain the general requirements of International Accounting Standard number 12 relating to accounting for deferred tax. And then number 2, we are asked to explain the purpose of providing for deferred tax. Like, why do we provide for deferred tax? The last thing that we need to do as we'll be answering this question is to, in respect of the above item of the machinery, prepare the extract from the financial statements of the company for the year that ended 31st September 2018, showing the impact of deferred taxes. So, colleagues, it's very important that you understand how to treat taxes. International Accounting Standard number 12, that talks about the taxes. This one is there always, and it's examinable. You really need to understand this, okay? Without you understanding this, then you are not doing anything. So it's very important. And please, I encourage you that you pay attention to this and you get to understand. What are the general requirements of International Accounting Standard number 12? Okay, what are the general requirements? Okay, now the following are the requirements. So we want to talk about the general requirements of International Accounting Standard 12. And we'll also explain the purpose of providing for deferred tax. Yeah. And we'll answer this particular question. So now you have to pay attention here. May I just have a minute? I get the solutions prepared so that you are able to follow nicely. Okay. Okay. These are the requirements, the general requirements, and I will go through them slowly. Number 1, deferred tax is the future tax effect of temporary differences, okay? Is the future tax effect actually of the temporary differences. So if you want to attend, deferred tax is the tax that is actually payable or is recoverable in the future, okay? That's tax which is payable and is recoverable in the future. By the way, I will show the calculations up in the statements of, in the financial statements. What do we mean now when you say temporary differences? This is where the question starts from. The temporary differences are basically the differences between the carrying amount of an asset or the liability in the statement of financial position and the tax base, right? That difference, you take the difference between the carrying amount, right? The net book values, the amounts that are sitting in the statements, and the tax base, which is actually the amount that the tax authorities assign to that particular asset or liability. So there is some amount that, or some value that the accounting authorities are going to assign to a specific asset. The question is that why are they assigning some value? Okay, why should they assign some value? It's very important for them to assign some value because this value is for tax purposes. Okay, so now what usually happens is that you may find the authority has assigned and the real actual amount, okay, right? That's that actual amount. So the difference that you take is what is called what? Is what is called the temporary differences. Okay, right? That's what you call the temporary differences. Yeah. And why do we call these differences temporal? Because they are not really going to be fixed. And this understanding is supposed to be there by. Okay, let me start by showing you. In your books, right, you write that the carrying amount of an asset, let's say you say is 1,500. And then the tax authority, they're going to give some value. Let's say the tax authority say, no, the value of this is just 1,000. Have you seen that there is a difference? Okay, there is a difference that has been put, right? Now, there is this difference between how much the asset carries and this difference, 1,500 minus 1,000, which is 500, is what we call, the temporary difference. Now, the temporary difference is that amount, this difference, okay? It may be positive or negative, right? Depending on what is, which one is higher than the other between the carrying amount and the tax base. By the way, the tax base, I said, is the value that has been assigned by the tax authority, right? So in this case, our carrying amount is 1,500 and the tax base is just 1,000. Then the difference is 500. That 500 is what you call the temporary difference. This is very important to use it even when you are doing the calculations in the assignment. So you need this, or even in exams, you use this, what I'm explaining. So you need to get it. So this is the difference I'm talking about, right? This is the difference I'm talking about, the 500 difference. Okay. Now, when you get that difference, I was commenting on the fact that I said it is said to be temporary difference, right? Why is it temporary difference? Okay, because this temporary difference is divided into two parts. There is the taxable. There is what we call the taxable temporary difference and the temporary difference that is deducted, right? Deductible. The taxable temporary difference, okay, why we say, first of all, why do we say it's temporal? It's temporal because it's not a fixed amount, because after some time, some future time, we may go to talk and prove to the, for example, to the tax authority. We prove to the tax authority that no, actually our assets, you valued our asset at this amount, at 1,000, but our asset, the value of our asset is what? Is 1,500. Once that has been proven, it means that these guys, they undercharge some taxes to us. And we will need to pay what? We'll pay taxes. So the taxable temporary difference results into some taxes. You have to pay tax. But if the opposite happens, that our carrying amount that we have stated is less than the taxable amount. For example, the tax authority give maybe 2,000. Then as we say, our carrying amount is just 5,000. 1.15. After some time in the future, if we'll be able to prove to the tax authorities that they overvalued our assets, actually our values, so which means the amount that was chargeable in terms of tax was way higher, and for that reason, the tax authorities have to give us money. They have to give us back our money. We have to recover that money. For that reason, that's why we say it's temporal, because there's still some need of proving at some point that convincing. Okay, so this is what usually happens, and those are the two types of the differences. I'm just trying to underscore the key general requirements. Now, I've said that the temporary differences arise when items are taxable or allowable in the periods different from those in which the matter is recognized for financial statement purposes. Let's have the tax base. The tax base of an asset, this one, is the amount which will be deductible for tax purposes against any taxable economic benefit which will flow to the entity when the asset is recovered. This is what I was just from saying. So now, when you look at these benefits, the benefits are not taxable. The tax base will equal the carrying amount. Right. If the tax base of a liability is its carrying amount, get that if the tax base, carrying amount and the tax base, they are equal, right? If there is that, then a tax base of a liability is its carrying amount. Then from the carrying amount, you have to less any amount which will be deductible for tax purposes in respect of that liability, especially in the future. Now, if the liability is revenue received in advance, okay, then the tax base is carrying amount less any revenue which will not be taxable actually in future. I repeat that point. If the liability, for example, is the revenue received in advance, right? You received some revenue in advance. Then the tax base will be the carrying amount less the revenue which will not be taxable. That cannot be taxable in the future period. That is how you handle this. Okay. Now, you see, the general requirements of International Accounting Standard number 12 are that the deferred tax liabilities, they have to be recognized on all taxable temporary differences. Get clearly what the standard says. The deferred tax liabilities, they should be recognized on all taxable temporary differences. That's where you recognize the deferred tax. So deferred tax is calculated on the what? On the temporary differences that I've explained to you how they come about. So the International Accounting Standard number 12 usually says that the deferred tax asset should be recognized for deductible temporary differences. That is, if it is probable that the taxable profit will arise in the future against which the deductible temporary difference can be used. So deferred tax is provided on the temporary differences at the expected tax rate in force when the timing differences reverse. And this is what usually happens. So you do the percentage on the temporary differences. That's how we get the deferred tax. And I'll show you using figures, using numbers very soon within this same conversation. Now, what about the current tax rate? Usually you use the current tax rate when you're doing this. Now, the deferred tax expense will normally be charged against profit in the statement of profit or loss. But there are some exceptions to this, right? So the exception is that the deferred tax charge arising from revaluation of a non-current asset, that is the exception. So in that case, the deferred tax is actually debited or deducted from the revaluation surplus. That's what happens. The other question was asking us to give some explanation, okay, on how you treat or why it is necessary for us to set up the deferred taxes. Why do we need deferred taxes? You see? Because the deferred taxes will arise because of the temporary differences that exist between accounting rules for recognizing the profits and the equivalent taxes. You know, there are some taxation rules that are there, and the accounting standards on how we recognize some profits. So there'll be those differences that are there, right? Now, when you look at these differences, they potentially result in profits being recognized in the statement. Of course, these are financial statements in accounting periods different from the period in which the entity is actually liable to pay tax on such profits. Okay, that will lead to a mismatch between the tax expense in the income statement and the profit against which it is being charged. So the purpose of the deferred tax is to alleviate this mismatch by recognizing the tax effect of transactions in the period which such transactions are recognized in the accounts, rather than the period in which the tax effect actually, crystallizes in the tax computation. So this is what happens. That's the whole idea behind the deferred tax and why we need it. So it's very important that we understand. Now, let's go to the mathematical way of treatment of this. How do we actually treat this mathematically? This is very important. And I need you to understand how we treat the taxes. The mathematical approach of taxation, First of all, let me talk about the tax. Let me talk about the tax amount to be recognized in the profit and loss. To be recognized in the tax amount, to be recognized in the what? In the profit or loss. What tax amount is to be recognized in the profit or loss? That's the question. What tax amount is that? This is what we should start by understanding. So let's start by looking at what is called tax expense. We usually do some tax expenses. Tax expense. Now, let me underscore to you that tax expense that you report in your statement, for now, we will make a few adjustments, but for now, let's start with this. It is actually the current tax. You're not just going to put only the current tax that you have seen. No, it is the current tax plus the movements in the deferred tax. And you now understand what deferred tax means, isn't it? We have explained what it means. It is calculated on the, on those differences, the temporary differences. Okay? Plus the movements in deferred taxes. Right? The current tax plus the movements in the deferred tax. So we have to check the movements in the deferred tax. Get the current tax, then add the movements in the current in the deferred tax. Then those movements, whether a decrease, if it's a decrease, you have to deduct it from the current tax. Then that difference is what you report as tax expense in your profit and loss statement. This is what you're going to be doing even in an exam, anywhere, also even in the assignments. Identify the current tax, then you should know the movements. So I will show you now how to find the movements in the deferred taxes. Okay. Now, what you have to understand is, let's say, for example, so that you understand the movement, you may have the deferred tax in the question. You have some deferred tax. Let's say your trial balance is here, has got debit, has got credit. Let's say the deferred tax that you have been given in the question is what? is credit. It's on the credit. You have a credit of 1,000, right? And then, okay, and then your, let's say your current account, let's say your current tax is what? It's 800, right? Then when you calculate, okay, if you calculate your deferred tax, by the way, you may have the deferred tax that you have in the trial balance and the one that you're going to calculate, the way how I've taught you how to calculate the deferred tax. I've said, you say the percentage, you take the percentage that you're given in the question of the temporary difference that you have found. So it is that difference that you have found, then multiplied by what? By that percentage. That is the calculated deferred what tax. So when you find this calculated deferred tax, let's say you have found that it is reduced to 700. So there is a difference here. It's actually a reduction. A reduction of how much? It's a decrease from how much it was to 700. So this is a decrease of what? 300. So you got to deduct this 300 from 800, the current amount. So you will report 500 as tax expense. That's what you're going to do. So the movement here has shown that it's a decrease. And if the opposite happens, that you have an increase, let's say, for example, you have an increase, okay? You got an increase from 1,000, maybe you found that it's become 1,500, right? 1,500. So there is that increase of about 500, right? It's positive 500. It's an increase. When you calculate, you find 1,500, so there will be an increase. Take the difference between the two, of 500. This 500 shall be added to the 800 being the carrying amount, yeah? I've talked about the carrying amount. You got to add these two, and that amount, that sum you have found, is what you're going to report in your statement. This is very important for you to get to notice and understand. Okay? Then again, when we continue looking at this, we will understand something very interesting. The issue of the deferred, let's talk about the issue of the deferred tax liabilities. How do you make treatments? Because this is very important. Because deferred tax, you may be wondering, sometimes you find the deferred tax in your statement on the liabilities section. Sometimes you, as you are looking at the statement, you may find it under assets. But why? Why should it be sometimes sit on assets, sometimes sit on what? On liabilities. I'll explain to you. Let's say now this deferred tax is a liability in the meantime. What do you do to the difference? So if it's an increase, the increase will be added to the current. Why are you adding an increase in the deferred tax? Right? If it's a liability, add that increase. But if it's a decrease, and you check that it's a liability, the liability has decreased, then you got to subtract it. This is the treatment. You will subtract that. What if the deferred tax is under the asset? It's an asset. You just check the liability properly, the way how the deferred taxes are put on the trial balance, right? You find the debit or credit properly. So you know that the assets are debited or liabilities are credited. You find it on the credit side, that's a liability. You find it on the debit side, that's what? Debit side, that's an asset. So if it's an asset, the increase, if you calculate, then you find that there is an increase. Please, the increase is subtracted this time around from the assets. Why should the increase be subtracted? The increase from assets be subtracted from taxes, because we are reducing that figure, right? We're reducing that amount. But if it's a decrease, in this case, you add, you more like do the opposite. The decrease shall be added. I know an example will do better to help you understand this. So the deferred tax is handled in that way. Okay, the deferred tax is actually handled in that way. Now, we have talked about the deferred tax and you're able to make adjustments in the movement of deferred taxes. But what about the current tax? Because I've just commented on current tax, I said current tax, but it does not just remain the same as well. There are some few and very few adjustments that you need to. What shall be the tax, the tax expense, the current tax? It may sit either on the debit or credit side. Okay. Now, if the current tax is on the debit side, please get this message. If the current tax is on the debit side, then you understand that there was an under provision. There are under provisions on the taxes. And the opposite is true. So therefore, the tax expense that you're going to report will actually be net current tax. Wow. Net current tax minus the movements that I've talked about in deferred what? Tax. I've talked about the movements in deferred tax, how to make adjustments here. But on what comes, okay, what forms the net current tax? That's the question. So the net current taxes are made up of the following. It is actually the current tax plus under provision. If there is an under provision, please, there is an under provision when you check, add that under provision. Then if there is an over provision, subtract the over provision from the current tax. And once you do that, you will have the net current. That figure, the net current, you should deduct the movements, right? You can deduct the movements in the deferred tax. If the movements leads into an addition, you can add the movements depending on the sign. And then that is how, that's the tax expense that you're going to actually report in the statements of profit and loss. Let's now pick, let's go ahead and pick an exam question to just cement our understanding. To show you, I want to show you how to calculate for tax using an exam question. Just gonna show you how to treat and how we calculate for tax using an exam question, because that is very important that you understand how we do tax computations. Yeah, I'll just do the computation just for tax for this one. These workings, we'll do them in the next conversation. But right now, I just want to focus on the one for taxes. Yes, just one for taxes. Right. We just want the one for taxes so that you understand how to treat taxes properly. There is this question that we will be doing, like we'll do the whole lot of it. It's a question on the published accounts. But on this part of the question, I was just interested on the parts for tax, okay? Just how to do that working, the workings on taxes, basically. That's what we are doing. Then in the next conversation, we'll do the other workings, okay? So how do you do the workings? This is very important. How do the workings go? Remember, I've told you that the tax expense that you're going to calculate, it shall be the difference between the current what? Current tax and the deferred what? Tax. Let's start from the current tax. How do you find the current tax? Number one, you should get the current tax from, okay, you should get the provision current tax that you have, okay? Right? The provision current tax from the previous period is given, right? Let's read it. The provision current tax from the previous period is actually given. Let's read adjustment number 4 so that you understand properly. Here is additional information number 4. And listen carefully so that you understand what we are talking about. It says that the directors of Mununga have estimated the provision for income tax for the year ended 31st, 2019 at 13.5. So there is the provision of 13.5 at the beginning of the period. You have this, the current one. This is the time when you're crossing the period. So there is this provision. It is what? 13.5, which means 13,500. Since we have 3 zeros on top for millions, these are figures are in millions, okay? There are 3 zeros on top. And then, what do you do to this? To this, you can add an under provision or over provision, right? Okay, add an under provision or over a provision. Okay, yeah. So now, we say that you have to get back to the question. What does the question say? In the trial balance, we have the current what? The current tax. And our current tax is where? Is on the debit side. Have you observed that? But what did I say if the current tax is on the debit side? I said if the current tax is on the debit side, that is an under what? Under provision. So you add this amount, 2,100 in this case, to the current. So the current, the provision that has been given, the current one, which is the current amount, carried forward, then add the provision that is there in the statement, whether it's an under provision or over provision. Under provision, debit side. Credit, you know what it means. It means over provision. So when you do that computation, then you can add these two, and they will give you actually the charge to profit, how much you're going to charge to profit or loss, to PL. In this case, 13,500 plus 20,100 gives us 15 what? 15,800. Okay, it gives us 15,800. That's what it does, 15,800. That is the amount of carrying amount. Remember, I've told you that the tax expense you report is the difference between the net carrying amount and the what? The net carrying amount and the deferred tax. Let's deal with the deferred tax now. Let me put down here, deferred tax. What are we given about the deferred tax? We need the carrying amount for deferred tax. Getting back to the same question, the same adjustment or additional information note. What does it say? The same note continues, says, the required deferred tax provision at the closing of the period, being 31st March 2019, is 16.8 million. So you are given already the current deferred tax, right? In this case, it has been given for you. You never needed to calculate for it like the difference between the carrying amount and the tax base. Here it has been given for you in that additional information. So this one is straightforward. So get that amount that has been calculated. So the deferred, the provision, how much is it? 16,800, which is 16.8 million. 3 zeros on top. To this amount, you have to look at what? The provisions that you have been given now in the trial balance. Let's get back about deferred tax. What are you given about the deferred tax? Deferred tax is on the what? Where is the provision? It's on the credit side, 25,500, right? 25,500. And we said that if it's that, what do you do? Right? If it's on the credit side, these are the provisions. If the provision is on the credit side, what do? That's an over provision you deduct, isn't it? You said over provision you deduct. That's what I just said. So you go here and deduct from this very amount. You're gonna deduct how much? The 25,200. And the difference between these two, it will be the negative value. This one, obvious. How much is this? 16,800 minus 5,000. 0 here. Okay. This is negative 8,400. And this is what you're going to charge. Actually, you credit this. You're going to credit this to the what? To the profit and loss account. Okay. This is for the deferred what? Tax. Then what do you report as tax expense? I told you it's the difference. So the current amount now that you have is what? 15,800. That's what we calculated. Then this one is a difference. It's negative. The difference is negative here. So if you put it negative what? 8 minus 8,400. The difference between these two is 7,200. Of course, there are 3 zeros. These are 7,200,000. This is the tax that we are going to pay. Is what you're going to report, please, under taxes in the statement of profit or loss. You go, you record this 7,200. Okay, that is how you record this 7,200. At least we have done even an exam and an exam question, 2 exam questions actually, relating to International Accounting Standard number 12 and how to deal with taxes, both in the standard as stipulated by the standard and also how this sits in the published accounts. Is there any question? If there is no question, we can end here. Thank you so much for tuning in.